Hey guys, welcome back to the channel. Wanted to give a big thank you to all the new subscribers to the channel as we get into today's video. Should we start investing, and when should you start investing? So when you think of the $1,000 that you have saved, whether it is an emergency fund, whether it's in your budget, that is not the point to start investing, guys. There are really two different things to think about here. One, do you have $1,000 in money? Do you have $1,000 in investable assets is the second. So when you think about the $1,000, you don't want to be putting it into the stock market, pulling it out a couple days later. You really need to start with that emergency fund, and it is the baseline when it comes to financial counseling, when it comes to education. Really starting with that $1,000 emergency fund is the baseline for everybody. Before you look at stocks, before you look at bonds, you want to be saving that $1,000. Now the biggest reason for this, guys, is of course if an emergency happens, you might have some money in investment, you'll be very eager to pull it out to cover that expense, and or you'll go back to credit cards, you'll go back to borrowing money, which is the next step. When you look at step number two, or really the second big caveat to look at, it is debt. You shouldn't start investing if you have debt. The reason being, when you look at the longevity of having debt, when you look at the balances, and also when you look at the interest rates that you see of debt, more normal credit cards are 20, 23, 25%, which is incredibly high. Even looking at the average stock market return, which yields 6 to 8% on average, if you're paying 10, 15, 20+% in debt, your $1,000 that you could be putting into the market will be a lot better poised in getting that debt down. Once you have debt eliminated, under control, things of that nature, that is kind of point one, or the very first step of when you could look at investing, is when you have that emergency fund that you're not going to be borrowing again and the debt is eliminated. Now I know Dave Ramsey is a big proponent of this, and I agree with it in its entirety, guys. Now there is a little bit of caveat item to this, and we're going to go through this step by step. Number one, making room in your budget for investing. This one is huge, guys. Now, why do we always target the 15%? This is kind of the baseline consistency month after month, year after year, even decade after decade, to build $1 million plus portfolio. It is 15% of your income. We've used the 50-30-20 rule. We've used zero-based averaging for your budgeting. There's a lot of different reasons and a lot of different ways that you can break this out, guys, which we've covered. 15% also does leave a little bit of wiggle room if you're doing, again, the 50-30-20 budgeting. When you look at the 20%, if 15% of it is going into an investable asset, if it is going into stocks, bonds, 401k, whatever it may be, you still have that 5% left that you really have a wiggle room to kind of play around with, whether it's going into college funds, whether it's going into anything else. Because remember, at this point, the elimination of debt has been completed, and that is one of the big things, guys. Now, another thing you really have to look at is what you're investing in. This is one of the big proponents why I am very heavily invested in the S&P 500. It is not only the risk mitigation of having everything across multiple markets. So if you do have one sector of the market that is doing incredibly well, such as tech, when you look at 2022, a lot of the rest of the market can make up a lot of the stocks that you do have in the portfolio. And you're also, again, mitigating your risk by investing in a much broader index like an ETF versus picking individual stocks. Personally, again, I do not and I will not buy individual stocks. I find little to no value in there, even though a lot of people are, hey, put all your money in this and that other thing. I don't pay attention to it, guys, because with investing, it is a long-term game, and that is one of the very first things and fundamental things that you have to do when it comes to investing strategies. Is it is long-term. It is not, hey, I'm looking at my portfolio every day. It's, hey, I'm dollar cost averaging every 2 weeks, every month, every time you get paid into that 401k, into that IRA, and you are really stacking that out. So some quick tips, guys, to save money. Cut down on food bills. You can really see what you're utilizing. This comes in all kinds of forms to save money, whether it is refinancing a car to get a lower rate, refinancing a home to get a lower rate, even cutting back on a lot of brand name things, going with generic options, shopping around for things that are cheaper, whether it is cable, whether it's subscriptions, whether it's insurance. There is an incredible amount of things that you can get that are much cheaper from other sources that people don't know about. They just stick with what they have and they don't want to do the work. And I apologize about the car because that is paid off, guys. That is part of the debt. Most people do not see cars as debt. Now, this again, fundamentally is something that you have to change with your mindset. When you think of the monthly liability of a car, not only do you have a payment that you're paying interest on, which roughly currently it is about 6%, which again, it is a debt that you have. When that debt is paid off, when that car is free and clear, you can actually take the money that you have in that payment, go ahead and put it into those investment accounts and really super superpower and supercharge when you look at your investments. Now, starting off with the 401k, this is really the basics. If a company has a 401k and they do offer a 401k match, this is what is going to be the first vehicle to take you to that 15%, guys. Now, with the caveat of this, you do have to think about it in a big picture and do some of the research. What I mean by this is you have to know what your 401k is vested in and what it is invested in. That is really one of the big things. I have noticed that a lot of target date funds kind of do not perform as well as the S&P 500, do not perform as some of the large cap, mid caps, and small cap ETFs and stocks. We see, again, a majority of people are invested into those target date funds, but the target date funds, depending on what your company has, might not be performing as well as you think. Now with this, guys, again, depending what you can put your money in. So let's say, for instance, my company offers a 401k match. Right off the bat, I'm going to match that 401k. That is free money. That is money that you do not want to give away. That is not money that you want to get on, that you actually get for free from your employer. With that being said, depending on the offering of your 401k plan, it might be better to put your 4% into that 401k to receive that full match, taking the 11% of the 15% that we have and investing it yourself. Could be IRAs, could be Roth IRAs, could be a lot of different things to make up an investment vehicle that is going to work for you, depending on your income, depending on your tax brackets. But you have to get the most out of that 401k, guys. Again, it's interesting to see that people will put a lot of money into the 401k, even higher percentages into a 401k, and they will never look at it. They will never bother with it. They might look at it on a rainy day, once in a blue moon. But you put that same amount into a stock portfolio, you bet most people are checking it every single day, if not multiple times a day, to see if it's going up or down. If it goes down, all of a sudden, boom, everyone pulls the money out. Now with the 401k plan, of course, it's not that easy, and they intentionally do not make it that easy to take money out of that plan. Now, as we get into the Roths and the IRAs, guys, really the Roths and the traditional IRAs are two factors that you really have to take into account on when it comes to taxes that are paid. For instance, my wife and I are in a very high tax bracket. We are not eligible to put money into an IRA, so make sure that you understand exactly what you can do. Now, of course, putting it into a traditional IRA is going to give you a tax advantage in the year that you do make the contribution up to the max amount, but taking that same funds and putting it into a Roth IRA does have benefits as well. You're not going to see the immediate tax advantages, but long term, you're going to see much larger advantage with the Roth IRA, depending again where your tax bracket is, which I would talk to a financial accountant or a financial advisor and really devise an investment strategy, which is our final point, guys. Work with a professional. I cannot stress this enough, guys. There is an incredible amount of services out there, including credit unions that do offer investment professionals, from, registered licensed investment executives that work for free, that will actually do all of this planning for free. Financial counseling does kind of the exact same thing, except we are not licensed to go into that area of making investment decisions, but we can plan, we can budget, we can say, hey, there is X amount of dollars to put aside when it comes to the investment. So how can you start investing with little money? There are a ton of ways, guys, including M1 Finance. That is what I use. The affiliate link is right down below if you want to check it out. With them, you can invest as little as $25 at a time. It's $100 to open the account. It is $25 to go ahead and start investing. That's it, guys. So it is not, hey, I need $1,000, $5,000, $10,000 to open an investment account. You can start with $100, guys, and really get this started. What is the best age to start investing? Today. Every single day is the best day, guys. Markets up, markets down. There's always going to be a lot of fluctuation within the market. The sooner that you start, the longer you're going to have to, of course, get that compounding interest, and the rate of returns is going to average itself out over when you look at a year, 5 years, 10 years, even looking at 30, 40 years, guys, the more that you put into this and the more dedicated you are to the investment strategy, the better it is going to perform, the bigger balance you're going to have at the end when it comes to retirement. So guys, so that'll do it for today's video. Let me know in the comments what you guys think about the videos, what you guys think about the editing and everything else that we do have going on here. So again, that'll do it for this video. Let me know what you guys think. And as always, thank you guys for watching.